Let's talk about the structures that Affluent Aussies often use. Firstly, starting with the primary residence, that should be owned in your personal names so that you can still get the CGT exemption for primary residences. Now, often that will be owned by one spouse rather than both jointly if a person's occupation is one that is at risk of litigation. So things like builders, sometimes people in the medical field, things like that, it might be owned by the spouse. Often then clients who are affluent will have a family trust, and in a family trust, it will hold a lot of their investments. Now, the investments in this trust, they need to split out that income. So often it will go to the two spouses, up to children, up to a certain point when they're under 18. So because kids only receive $416 tax-free, so you can't allocate too much to the children until they're 18. Then a company structure is sometimes used because the company tax rate is lower sometimes than the spouses. And then occasionally also there's other family members who maybe aren't working that can be used in this discretionary trust structure. So that's a way of tax planning. But the other reason for a trust is also asset protection. Because these assets are in the trust, they have extra protection over owning the assets individually. Now, down here, I've also got what's called a testamentary trust, because often when these clients get a will, they'll also set up a testamentary trust provision in their will. And that means that their assets can go into this testamentary trust structure. And that's really beneficial. The main reason is that these kids no longer have that $416 a year tax-free threshold, but it goes up to adult tax rates, which is closer to $20,000. And it's a concession that people are allowed to use because obviously losing a parent is a really significant blow. So they get that tax concession to help with, all the extra costs and potentially a lack of income as well there. Self-managed super fund, it's definitely not mandatory for affluent Aussies to have this. Sometimes it can be worthwhile from a cost perspective if the balances are high enough, because obviously with a normal retail or industry fund, they'll be charging often a percentage-based fee. So in some cases, a self-managed fund can be cheaper, but it's also for more sophistication around what products you can have. As an example, sometimes these affluent Aussies are business owners and they might want to own, say, their commercial property for the business in the self-managed super fund.